You never voted for this deal. You never saw it debated, but it shapes your taxes, your savings, and the price of your future. Every time a government runs out of money, the same doors quietly open, and the same institutions are already waiting inside. This matters right now because governments across the world are deeper in debt than at any point outside of major wars. Interest rates are high, growth is fragile, and the relationship holding the whole system together is under strain. So let's talk about the silent deal between banks and governments, not the one in speeches, the one in balance sheets. Here's the simple version we're told. Governments need money to function. They issue bonds. Banks buy them. Everyone wins. Roads get built. Teachers get paid. Stability is preserved. That story is tidy and incomplete. In reality, this relationship formed out of crisis, not design. During wars, depressions, and financial crashes, governments needed massive amounts of cash, fast. Taxes weren't enough. Voters weren't thrilled. So borrowing became the answer. Banks stepped in as the natural buyers. They had capital. They needed safe assets, and government debt was labeled risk-free. That label changed everything. Once government bonds were treated as safe by law and regulation, banks were encouraged to hold them, sometimes required to. A bank loaded with government debt looked stable on paper, even if the government itself wasn't. And governments noticed something important. If banks depended on government bonds to stay safe, then banks depended on governments staying solvent. And if governments depended on banks to buy their debt, then governments depended on banks staying alive. That's the deal. Step by step, it works like this. Governments spend more than they collect. That gap is covered by borrowing. They issue bonds, IOUs. Banks buy them, directly or indirectly. Those bonds sit on bank balance sheets as safe assets. Now add central banks. When trouble hits, central banks step in and buy those same bonds from banks. This injects cash into the system. It stabilizes markets. It prevents panic. On paper, it looks like emergency medicine. In practice, it's routine life support. Here's the uncomfortable math. If bond prices fall, banks take losses. If banks wobble, governments are forced to rescue them. If governments wobble, banks' safe assets stop looking safe. So neither side can afford to let the other fail. This is why bailouts aren't accidents. They're features. Publicly, we're told bailouts are rare, temporary, regrettable. Privately, the system is built assuming they will happen. And here's the irony. The more debt a government issues, the more the financial system depends on that debt being honored forever, not restructured, not inflated away too quickly, not questioned. Debt stops being a liability. It becomes infrastructure. Meanwhile, voters are told debt doesn't matter, or that it's a problem for later, or that markets will discipline bad behavior. But markets can't discipline governments if disciplining them collapses the banking system. So discipline turns into negotiation, and negotiation turns into quiet accommodation. This is where the hype and reality split. Publicly, governments promise independence from banks. Banks promise discipline to governments. Central banks promise neutrality. In reality, each one is trapped by the other's balance sheets. This is why inflation gets tolerated longer than promised, why interest rates move slower than expected, why temporary measures last a decade. No conspiracy is required, just incentives. Over the long term, the risks are subtle but serious. Debt grows faster than economies. Banks grow larger and more politically sensitive. Central banks become permanent market players, not referees. The system survives, but flexibility shrinks. Eventually, every option becomes painful. Raise rates and governments strain. Lower rates and savers lose. Let markets reset and banks break. So the deal continues, not because it's perfect, but because breaking it is worse. And that leaves us with an uncomfortable thought. If the financial system depends on a promise that can never be tested, what happens the day it finally is? That's the deal you never voted for. And the bill hasn't arrived yet.